Have you ever wondered how the world's most successful investors approach the stock market? How do they consistently create legendary investment performance? How do they find undervalued assets and minimize their risk? Meet Seth Klarman, hedge fund manager and one of the most successful investors of all time. Seth Klarman was born in New York in 1957. He is a proponent of value investing. He bases his investing approach around the philosophy of Ben Graham. Seth Klarman is the president and CEO of the Baupost Group, a Boston-based private investment company he founded in 1982. Today, Baupost Group manages more than $30 billion in assets.
Margin of Safety: Risk-Averse Value Investing Strategies for a Thoughtful Investor is a book written by Seth Klarman in 1991. This book remains highly regarded in the investment community and is considered a classic in the field of value investing. It is currently out of print, and copies of the book can sell for thousands of dollars on various platforms due to its rarity and popularity among investors. In this book, Klarman first points out the various traps that investors face, and then introduces the concept of value investing and explains its underlying logic, revealing why value investing succeeds. Now, let us take a closer look at some of the highlights in this book. Many investors are motivated by the desire to make quick profits from rapidly rising prices, which can lead to them engaging in speculative investments. It's important to know how to distinguish between investment assets and speculative assets, and we can listen to what Klarman has to say about it.
There is one critical difference. Investments throw off cash flow for the benefit of the owners. Speculations do not. The return to the owners of speculations depends exclusively on the vagaries of the resale market.
That is to say, the main difference between investments and speculations is that investments generate cash flow that benefits the owners, while speculations do not. With speculations, the return for the owners depends entirely on the unpredictable nature of the resale market.
Collectibles, such as art, antiques, rare coins, and baseball cards, are not investments, but rank speculations. Even Wall Street, which knows better, chooses at times to blur the distinction. Salomon Brothers, for example, now publishes the rate of return on various asset classes, including in the same list U.S. Treasury bills, stocks, impressionist and old master paintings, and Chinese ceramics. Investments, even very long-term investments like newly planted timber properties, will eventually throw off cash flow. A machine makes widgets that are marketed. A building is occupied by tenants who pay rent. And trees on a timber property are eventually harvested and sold. By contrast, collectibles throw off no cash flow. The only cash they can generate is from their eventual sale. The future buyer is likewise dependent on his or her own prospects for resale.
Value investing is a bottom-up strategy. However, many investors use top-down approach. Klarman writes,
"A great many professional investors employ a top-down approach. This involves making a prediction about the future, ascertaining its investment implications, and then acting upon them. This approach is difficult and risky, being vulnerable to error at every step."
According to Klarman, top-down investors need to make accurate predictions about macroeconomic conditions and correctly understand how they will affect different sectors of the economy, specific industries, and individual companies. This process must also be done quickly and accurately, or other investors may beat them to the punch and cause prices to reflect the predicted developments, making it challenging for latecomers to profit. In summary, top-down investing is a complex and time-sensitive process that requires accurate and fast forecasting to be successful. Klarman writes,
The top-down investor thus faces the daunting task of predicting the unpredictable more accurately and faster than thousands of other bright people, all of them trying to do the same thing. There is no margin of safety in top-down investing. Top-down investors are not buying based on value. They are buying based on a concept, theme, or trend. Another difficulty with a top-down approach is gauging the level of expectations already reflected in a company's current share price.
In contrast, value investing uses a bottom-up strategy that identifies individual undervalued assets through fundamental analysis. Investors search for bargains, security by security, analyzing each situation on its own merits. The strategy involves buying a bargain and waiting patiently, regardless of the prevailing direction of the market. One significant difference between the two approaches is maintaining cash balances. Bottom-up investors hold cash when they can't find attractive investment opportunities and put it to work when they appear. They only invest when a diversified portfolio of attractive investments is available. The concept of the margin of safety was first introduced by the father of value investing, Benjamin Graham. However, Klarman provides a much easier and more profound explanation of this concept. Klarman writes,
"Because investing is as much an art as a science, investors need a margin of safety. A margin of safety is achieved when securities are purchased at prices sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world."
Klarman mentions Warren Buffett used a bridge weight limit analogy to explain the margin of safety concept.
"When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And that same principle works in investing."
Klarman believes that the element of a bargain is the key to the process of value investing. He says that,
in the language of value investors, this is referred to as buying a dollar for 50 cents.
However, there are two challenges involved. The first is discipline. The second is the complexity and variability of business valuation. According to Klarman, value investors should wait for the right pitch or opportunity, be patient and disciplined, and maintain the integrity of the valuation process. They should continuously compare potential new investments with their current holdings to ensure they own only the most undervalued assets available. The complexity of business valuation is a significant challenge for investors, as they cannot be certain of value, and many factors influence business value, such as the credit cycle, trends in inflation or deflation, and the possibility of sustained decreases in business value. So, valuation should always be performed conservatively. Investors should demand a greater discount between price and underlying value in a deflationary environment. To sum up, value investing requires discipline, patience, and a thorough understanding of the complexities of business valuation. Given the length of this video, we'll wrap up our discussion on the margin of safety here. Stay tuned for our future discussions on value investing.